Welcome back to the Book Digest. Today, we're exploring a territory that isn't made of land, but of capital, the wild, unpredictable world of the financial markets. And our guide for this journey is a really groundbreaking book that tried to chart it all, Trading Chaos by Justine Gregory-Williams and Bill M. Williams.
We're going to be unpacking the powerful and, really practical ideas from Trading Chaos. This is a book that promises not just a new strategy, but a completely new way of seeing the market itself. So, let's dive in and see what's under the hood.
The book kicks off with a really fundamental, almost painful question for anyone who's ever stared at a price chart. Why do so many traders, the vast majority in fact, consistently lose money? What are they all getting wrong?
And here is the book's radical answer. It's not because of a lack of discipline or some faulty indicator. Nope. The problem is way deeper than that. Most traders are trying to navigate a wild, chaotic jungle, but they're using a map that was designed for a simple city grid. Their map is just fundamentally wrong for the territory.
And that right there brings us to the first major mindset shift the book demands from us. If you want to trade chaos, you first have to stop thinking of markets as these simple, predictable machines.
This slide, well, it just perfectly contrasts the two worldviews. The conventional view, it sees the market like a clock, a predictable machine where what happened in the past reliably tells you what's going to happen next. But the chaos view says, no way. The market is a living, complex system. Think of it more like the weather, not a clock. A tiny, unpredictable change today can lead to a massive, completely different outcome tomorrow. That's what scientists mean by that phrase, sensitive dependence on initial conditions.
Okay, so if the old map is basically useless, what's the new one? Well, Bill Williams proposes a map that's built from the principles of chaos theory and fractal geometry. Let's take a look at what that actually means. First up, chaos theory. You've probably heard of the butterfly effect, right? The idea that a butterfly flaps its wings in Brazil and sets off a tornado in Texas? Well, in the markets, this means some tiny, seemingly minor news event, or even a single large order, can trigger a whole cascade of events, leading to these huge, unpredictable price swings. Trying to draw a straight line from cause to effect, it becomes pretty much impossible. But here's the cool part. Chaos isn't just a random mess. It has an underlying structure, and that's where fractal geometry comes in. A fractal is just a pattern that repeats itself at every single scale. Think of a coastline. The jagged shape you see from a satellite looks a lot like the shape you see standing right there on the beach. Williams argues markets are exactly the same. The patterns you see on a 1-minute chart, they have the same basic structure as the patterns on a weekly chart.
So, how in the world do you actually trade in this chaotic, fractal landscape? Well, Williams provides a toolkit that he calls the 5 dimensions of trading. This is really the practical heart of the whole system.
Now, these 5 dimensions are designed to be layered on top of each other to give you a complete view of the market structure and its energy. First, they find the basic structure with fractals. Then they measure its speed with momentum. Then they check for changes in that speed with acceleration. After that, they filter for the best opportunities with the zone. And finally, they identify the underlying trend with the balance line. Let's take a quick look at how they all work together.
So the very first dimension is the fractal. And all it is a simple 5-bar pattern, where the middle bar marks a short-term peak or valley. In a chaotic market, these fractals are like our first clear signposts, flagging potential points where the market might turn or where a new move might be starting. They really give us a foothold in all that complexity.
Next up, we have to measure the market's energy. Think of it like driving a car. Dimension 2, momentum, that's your speedometer. It tells you how fast the price is moving. But Dimension 3, acceleration, that's your foot on the gas or the brake. It tells you if that speed is picking up or slowing down. And Williams argues that seeing the market start to slow down is the absolute earliest warning you can get that a trend might be about to turn. Dimension 4, the zone, pretty much acts like our traffic light. It takes the signals from our speedometer and our accelerator and combines them. So when both momentum and acceleration are strong and pointing in the same direction, boom, we get a green light. That's a high probability zone to trade in. But if they disagree, it's a gray zone, a really clear signal to just stay on the sidelines and wait.
And this brings us to the 5th and final dimension. And honestly, it's captured by this fantastic metaphor, the alligator. The core idea is incredibly simple. You only want to trade when the market is feeding, not when it's sleeping. This is the famous alligator indicator. It's just a set of 3 specific moving averages that represent the gator's jaw, teeth, and lips. When those lines are all tangled up together, the alligator is sleeping, and the market has no direction. But when they spread apart and open up, the alligator is awake and hunting for a big move.
So the whole point is you only want to trade with an awake alligator.
Okay, so here's where the book takes a really interesting turn. Williams argues that even if you have the perfect map and the best tools, you can still get lost. And why is that? Because the most chaotic territory of all isn't the market, it's your own mind.
He lays out these 5 psychological stages, and honestly, this is where most traders get completely stuck, right in the first 2. They're either unconsciously incompetent, which means they don't even know what they don't know, or they're consciously incompetent, where they're just overwhelmed by how much there is to learn. The goal, of course, is to move up toward competence and eventually mastery, where trading becomes almost intuitive.
And this leads to what might be the most profound psychological shift in the entire book. Redefining what a good trade even is. It's not about the money you make or lose. A trade is good if you flawlessly followed the rules of your system. This means a small loss, taken exactly according to your rules, is actually a success. Why? Because you controlled the only thing you truly can control, your own actions.
So, after all of that, what's the final verdict on trading chaos? Let's take a balanced look at its contributions, but also at its limitations. On one hand, the book's greatest contributions are its intense focus on trader psychology, its attempt to build this complete multidimensional framework, and how it made really complex ideas like chaos theory accessible to a much wider audience. But on the other hand, its critics point out that there's a real lack of rigorous scientific testing for its unique indicators, and they also say there's kind of a gap between the high-level chaos theory and the more conventional tools it actually provides.
Ultimately, Trading Chaos is a really fascinating and pretty polarizing book. It tries to build a bridge that connects 3 very different worlds: hard math, human psychology, and the raw, day-to-day practice of market speculation. It's a super ambitious project that maybe doesn't always succeed perfectly, but it absolutely changed the conversation.
And that leaves us with one last big question to think about. Is the real, lasting value of this book found in the alligator and the fractal indicators? Or is it in the profound change in perspective it demands, teaching traders to see not just the market, but also themselves in a completely new light? What do you think?